The top 5 dividend stocks under $50. It's always nice to have a steady dividend income. And when the stock is under the $50, it's quite easy to expand the position with a monthly contribution, or maybe even with reinvesting the dividends. In this video I will discuss the best dividend stocks under the $50. Some of them are already in my portfolio, but some of them are still on my watch list and will definitely be added when the time is right. I'm very excited to see what you guys think about these stocks, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. Please subscribe to join the community and to receive multiple analyses every week, where I will tell you everything you need to know about the stock market. First stock on this list is Cisco, ticker symbol CSCO. This stock is down 30% year to date and has a current stock price of $44 as of recording this video. And PE ratio is sitting at 15, which is pretty low. Cisco Systems Incorporation is the world's largest hardware and software supplier within the network solutions sector. The secure, agile network business contains switching, routing and wireless solutions. Cisco has a 3.47% dividend yield, which is pretty high. The annual payout is sitting at $1.52 a share, and payout ratio sits at 44%. Meaning they have 56% left in cash to pay down debt, buy back shares, do acquisitions and all other things. The 5-year growth rate is sitting at almost 7% and it grew the dividends for 10 years in a row. From a dividend perspective, this is a really good dividend stock, I think. In this graph we see that the revenue is up in the past years, but it's not always consistent. But as long as it goes up, in the long run I think you are fine. Margins are also quite good, sitting at 23% in the 12 trailing months. In this graph we see that free cash flow is also up, but again, not really consistent. But I think it's the same story as with the revenue. When it's up in the long run, I don't see any problems. I think that's very important for dividend stocks are the share buybacks. With every share that they bought back, the EPS will go up. But it will also be easier to maintain the dividends and of course increasing them. In the past 5 years, Cisco bought back 70% of the shares outstanding, which is quite a lot. So this looks really good to me. My conclusion on Cisco is that it's a very interesting dividend stock. All fundamentals look really good and they pay a solid dividend, which is growing at a decent growth rate. From a dividend perspective, I think Cisco is a very interesting stock to buy. Second stock on this list is Citigroup, ticker symbol C. This stock is down 23% year to date and has a current stock price of $48 as of recording this video. And PE ratio is sitting at only 5, which is very low. Citigroup is an American multinational investment bank and financial service corporation headquartered in New York City. Citigroup pays a juicy dividend of 4.27% and an annual payout of $2.04. The current payout ratio is sitting at only 24%, which is really nice. This means they have 75% left in cash to pay down debt, buy back shares, do acquisitions and all other things. The 5-year growth rate is sitting at 26%, which is also very high. They grew the dividends for 0 years in a row and the last increase goes back to 2019, which is the downside of this stock. But with a dividend yield sitting at 4%, I don't think it's necessary to increase it even more. I think it's a good thing they invest their money also in other ways to grow the business and reward the investor. In this graph we see that revenue growth over the past years. It's not really consistent, but that's also something very typical for banks. Margins are looking quite good with 25%. In this graph we see that free cash flow is also not quite as consistent as I prefer, so you want to keep an eye on this number. But now the best part of Citigroup. They bought back 28.7% of the shares outstanding, which is a lot. This will add a lot of value to the investor, so this looks really good. It makes it also very easy to maintain and increase the dividends. Not all fundamentals look really great, but a 4% dividend yield with a payout ratio below 30% looks really attractive. They also bought back a lot of shares, so this could be an interesting dividend play. But keep an eye on the free cash flow and also on the revenue. Third stock on this list is Intel, ticker symbol INTC. This stock is down 27% year to date and has a current stock price of $38 as of recording this video. And PE ratio is sitting at only 6.4, which is very low. Intel is the world's largest logic chip maker. It designs and manufactures microprocessors for the global personal computer and data center markets. Intel is known for the steady dividends and, of course, the steady business. They pay a solid 3.78% dividend yield, which is pretty high. Annual payout sits at $1.46. Payout ratio is at only 28%, which is very nice. They have 72% left in cash to pay down debt, buy back shares, do acquisitions and all other things. The 5-year growth rate sits at 6.25%, which isn't the highest, but because dividend is already sitting at almost 4%, I don't think this is a problem. They grew the dividends for 8 years in a row. In this graph we see that revenue is going up quite nice and steady, except for the past 2 years, where it goes up and down just a little bit. So this is something you want to keep an eye on, but I think they will do fine. The demand for chips is huge, and with the new location they have created, they can also create a lot of new chips. Margins are also looking really great at 31%. Free cash flow is going up a lot in the past years. The latest drop we see is related to this new plan, so nothing to worry about for now. Overall, this looks very good. Intel bought back 30.6% of the shares outstanding in the past 5 years, which is quite a lot, and adds a lot of value to the investor. Next to that, it's easier to maintain and increase the dividends, of course, so this looks very good. My conclusion on Intel is that a lot of people see Intel as this boring company with not a lot of growth. But to be honest, I think from a dividend perspective and a value perspective, Intel could be very interesting. Fundamentals look really great and the demand for chips is very high. So for me, this could be a very interesting stock to buy. Fourth stock on this list is Stag Industrial, ticker symbol STAG. This stock is down 31% year to date and has a current stock price of $32 a share, as of recording this video. And PE ratio is sitting at only 26. Stag Industrial is a real estate investment trust, primarily involved in the acquisition and operation of single-tenant industrial properties throughout the United States. The vast majority of the company's real estate portfolio are warehouses and distribution buildings. People love Stag because of the monthly dividends. Right now they pay a solid 4.5% dividend yield, which is very high. And as I said, you receive a dividend every month. And this is also one of the reasons why I own this stock. But of course, not the main reason. The dividend growth isn't really that good, but with dividend yield sitting already 4.5%, I think it's all good for now. Since REITs have a dividend payout ratio, I will show you the payout ratio breakdown. Based on this year's estimates, payout ratio sits at only 67%, which is quite good for a REIT. Based on cash flow, it sits at only 57%. In this graph, we see that revenue is going up quite nice and steady, which is very important for a steady dividend stock. Margins are also very good at 37.5%. Free cash flow is going up quite nice and steady. And of course, there was a decline in 2020 related to the coronavirus. For a REIT, it's a bit different with the shares outstanding, since they issue more shares to raise capital and do acquisitions. So it's not necessarily a bad thing when they issue new shares. My final conclusion with this stock is that I think it's very nice to receive a monthly dividend. But this doesn't mean you should buy the stock immediately based on the monthly dividends. But with dividends sitting at 4.5%, I think it's a very interesting stock to compound. Last stock on this list is Hibbett Sports, ticker symbol HIBB. This stock is down 33% year to date and has a current stock price of $48 as of recording this video. And PE ratio is sitting at only 4.86, which is very low. Hibbett Incorporated is engaged in the retail of sport goods. The company operates small to mid-sized stores and is focused its business on the South, Southwest, Mid-Atlantic and Midwest areas of the country. It offers a broad range of sporting goods including apparel, footwear, accessories and equipment needed for team sports. Dividend yield is sitting at 2%. And annual payout is sitting at $1.25 a share. Payout ratio is sitting at only 11%, which is very low. This means they have roughly 90% left in cash to buy back shares, do acquisitions, pay down debt and all other things. This looks very good to me. They just started paying dividends last year, so it's quite logical there's no dividend growth rate. Revenue is going up quite nice and steady over the past years, especially during the lockdown periods. Now that revenue is a stagnating line, you want to keep a closer eye on this number. The current profit margin is at 8%, which is typical in this industry. The thing I like is that the current profit margin is significantly higher than the 5-year average. Free cash flow is going up, but it's not always consistent. So this is also something to keep your eye on, but in the long run, free cash flow is up. In the past 5 years, Hibbett bought back 38% of the total shares outstanding, which is insanely high and did add a lot of value to the investor. This will make it easier to maintain and increase the dividends in the future. My final conclusion on this stock is that I really like the fundamentals. It's a nice and steady business and it started paying dividends last year. And to be honest, it looks quite good. So I'm very excited to see what happens with the stocks in terms of dividends. So this was my top 5 dividend stocks below $50. It's always nice to have stocks with a low stock price and a steady dividend. This makes it very easy to reinvest the dividends and to buy new shares. But this should never be one of the main reasons. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I'd really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and we'll see you in my next video.